Section 2.3 covers professional investors. Now, we need to know the definitions of professional investors, and we have to be aware of the areas that are waived, the rules and regulations that are waived with regard to professional investors. Why? Because professional investors are deemed not to require the same level of protection as retail investors. The three categories: institutional, corporate professional investors, and individual. And we're going to look at the definitions of these now. Institutional professional investors, defined in the Securities and Futures Ordinance, and there they are. It's the big institutions worldwide, from exchange companies at the top to AFIs, similar overseas institutions. That's all the banks, insurance companies, etc. Corporate professional investors, as it says there, trustee companies responsible for total assets of not less than 40 million Hong Kong. So we have financial criteria here, which we did not with institutional investors. Corporations or partnerships having either a portfolio of not less than 8 million or total assets not less than 40 million. And corporations that act solely as investment holding companies and are wholly owned by persons who belong to any of the above two categories. Your classic corporate professional investor will be the family office, so an office managing money, often on behalf of a number of wealthy families. And then individual professional investors, high net worth individuals having a portfolio of not less than 8 million Hong Kong dollars, which is just over $1 million US. It is not, in this day and time, that's not that much. Now, what's in brackets is extremely important. Includes spouses, children, where portfolios are held jointly. What it does not include is parents and siblings. Why do I mention that? Because a question has started appearing asking you which of the following do you include when determining whether an individual is a professional investor or not in terms of the 8 million threshold. And the answer is you include the portfolios of spouses, children held on behalf of, not parents and siblings. Okay, the waivers applicable to professional investors on page 16. And this is just split up into Securities and Futures Ordinance provisions that are waived, and there is only one real issue for the exam: unsolicited call provisions. So what that is saying is professional investors can be cold called. We will cover the cold calling provisions in topic 7. And as it says, those exemptions apply to all three: institutional, corporate, and individual PIs. Then we look at the requirements of the Code of Conduct that are not applicable to professional investors. However, they're not all not applicable. It depends on the category of professional investor. And I'm certainly not going to go through it all in detail in this lecture. But if you read through the information that's not required and then look at the exemptions at the bottom that are highlighted and follow that through. Similarly for discretionary accounts. Institutional professional investors, as it says there, licensed registered persons are automatically exempt from the above listed requirements. So the institutional professional investors are exempt from everything, not necessarily the corporate and the individuals, and it's dependent on certain situations, and those are highlighted on page 17. Okay, let's now move on page 18 to the management, supervision, and internal control guidelines. Again, maybe 2 or 3 questions at the most from this area, but there's a lot of material. Now, as it says there, the internal control guidelines do not have the force of law. However, if you breach them, remember these are SFC guidelines, if you breach them, the SFC may not look kindly upon that. In the worst case scenarios, they'd revoke your license. Now, there are 8 key areas of internal controls I'm not going to read through these. These are reasonably straightforward. Just cover them yourselves and then do the questions. So page 18, we have management supervision. Then we have segregation of duties and functions. Then on page 19, we have personnel and training, information management, compliance. Then going on to page 21, audit. Now, when it says audit, it really means internal audit, the internal audit function that should exist, operational controls. Now, we've listed a whole host of control guidelines, examples that you should have the policies and procedures with regard to operational controls. These are examples. You certainly don't have to go memorizing these at all. Remember, you should have operational controls to make sure you're in compliance with the legislation, the rules, the codes, the guidelines. And so you should be able to rely on your knowledge of all of those regulations to determine the required operational control. Now, the last one is risk management, and as ever, we have the objective and the control guideline. Page 24, section 3.2 looks at additional information on operational controls and risk management. Now, if you covered this at paper 1, paper 2 takes this a little bit further. It's not difficult material, just I would suggest an awareness. There should be operational controls for account opening, for the operation of discretionary accounts, for providing investment advice, order handling, the dealing practices. Now, right at the top, it says there, order handling procedures should cover recording and timestamping of orders. We saw this earlier. Remember, the client orders should be timestamped when they are received. Concept of Chinese walls to prohibit price-sensitive information from circulating in an organization, back office and accounting, and asset protection. All of these extra controls are recommended. Now, on page 26, the identification of risk. As with paper 1, paper 2 covers 4 fundamental risks that you should be aware of. Liquidity risk, that's the risk of not being able to meet commitments while maintaining assets. Well, it's the risk of not having sufficient cash flow. Credit risk, the risk of losing money because a counterparty defaults. Market risk, the risk of the market going against you and losing money as a result. And operational risk, the risk of losing money because deficient, failed internal processes, etc. Now, we should have some way of measuring and monitoring and then controlling risk. So those are the 4 stages of risk management: identifying risk, measuring the risk, monitoring risk, and finally controlling the risk. Now, this is a favorite for the exam: risk management techniques. Now, the way that they often examine this is they will make reference to one type of risk and ask you which one of the following is a risk management technique for that particular risk. So there's the risk management techniques for credit risk, for market risk, for liquidity risk, and for operational risk. And it's an easy question to write. If you're an examiner, you just, for example, ask you which one of the following is a technique for managing operational risk. And you will pick 3 of the answers from credit, market, and liquidity risk, and then 1 from operational, which is the correct answer. Moving on to section 4, code requirements for a licensed registered person dealing on the stock exchange. Really, this boils down to 2 areas. 4.1, the options client agreement. Very specific. So if you enter into an agreement with a client to do options business, then you must have an agreement. And in that agreement, there's all the points that must be covered. Client disclosure in writing on true identity of the account owner, client's acceptance of the terms of contract, client agreement to provide registered person with margin, cash, securities, collateral, etc. Client's agreement to indemnify registered person against all losses and expenses resulting from breach of obligations. That is in the agreement, that has been examined. Client's right to have recourse to compensation fund, that's the investor compensation fund, if registered person defaults, that has been examined. Client's confirmation, he or she has read and agreed to terms which have been explained to him or her in preferred language. Risk disclosure statements, and then registered person undertaking to keep client options account confidential, except from SFC, Stock Exchange and Clearinghouse. Now that sub-bullet point on the exceptions to the confidential requirement has been the subject of a question. So I would know 4.1 because it's something that every now and then pops up as a question. Also, registered person undertaking to provide client with product specifications for options contracts and notify client of any material changes in its business. The other requirements relate to timestamping, options trade confirmations, capital adjustments, and client money with regard to traded option business. Remember, traded options are securities, and this paper is on the regulation of securities. So it's fair game for questions. I would refer back to 4.2.2, options trade confirmations. Now, this is not the agreement. This is a lot more granular. This is the confirmation of an options trade. And these confirmations should include details of the transaction, risk disclosure statements, fine. But this one sort of sticks out. Statement that client has right to claim under compensation fund if registered person should default. So you see that point not only under the client agreement, but also in the options trade confirmation. You may think this is all a bit nerdy, but we have seen these points examined and they are unique to paper 2, and that is why I'm highlighting them. Okay, section 5, prevention of money laundering and terrorist financing. Well, I'm sure many of you are sick to the back teeth of all this material. You will be exposed to it regularly at your place of work. Please be aware the ordinances, the legislation that covers this area in Hong Kong under section 5.2, we have AMLO, Anti-Money Laundering Counter-Terrorist Financing Ordinance, the Drug Trafficking Recovery of Proceeds Ordinance, that's the longest in Hong Kong, Organised Serious Crimes Ordinance, the Anti-Terrorism Measures UNATMO, United Nations Sanctions Ordinance, and Weapons of Mass Destruction, Control of Provision of Services Ordinance. Now, we then give details of each of these ordinances. Of all of them, the one that I'd be aware of is the Drug Trafficking Recovery of Proceeds Ordinance. Remember, it is an offence to deal with property known or believed to represent proceeds of drug trafficking. If you honestly did not know when you were dealing with the proceeds, that is not an offence. But as soon as you discover that the source of the funds was drug trafficking, then you must inform the police, basically, Joint Financial Intelligence Unit. And if you fail to disclose, you're breaking the law. You're committing an offence. And then we have the other ordinances listed there. Now, thankfully, we don't have to walk around with an in-depth knowledge of these ordinances because the SFC have provided a guideline on anti-money laundering and counter-terrorist financing, GAML. And you will have covered this if you've done paper 1. If not, I'm sure you are familiar with a lot of the material from in-house training and regulatory monitoring. So let's leave anti-money laundering. Indeed, we're going to be leaving topic 3 very shortly. Section 6 looks at enforcement actions that the SFC have taken. Case 1 on the failure in internal controls. Case 2, negligence, non-compliance with order recording requirements. Very detailed. Nevertheless, there have been cases against it. And there we are, related to something I've just touched upon, reprimanded and fined for breach of the GAML, case 3. I wouldn't say that you're going to be examined on these cases, but it just further illustrates the points that have been brought up in topic 3. Okay, as ever, the best way to further work on your knowledge base of topic 3, especially with this material, is not necessarily to sit and read it. It's classically forgettable. No, the best way to get it into your short-term memory is to practice questions. And as I've said many times, questions are provided on Examinator.online.